Good afternoon, beautiful people. Welcome back to Young Money Investing. It's Monday afternoon, so it's time for my weekly technical analysis where I go over market trend and price structure so that you can make better trading decisions and ultimately make more money. Now, normally I put these out Sunday afternoon or Sunday evening, but today is June 19th, it's Juneteenth. The markets are closed in observance of this holiday, and so I decided that I would put this video out today instead of yesterday so that you have all the knowledge fresh in your head when you wake up tomorrow morning bright and early to start trading. Now, if you appreciate this content, please go down, smash that like button, show me a little love and a little appreciation, and let's jump into. Alright, now we are starting off on a daily time frame looking at the DXY, the US dollar. You can see that we did get that move lower that I was talking about last week. Looks like we fell about 1.5%. You can see that we do have this very nice kind of curve action right here, looking just like this. And then you see this little retracement and then a much stronger move. Now, typically what you look for if you were going to short a position, kind of a nice rounded top, retracing up to the 20-day moving average, and then big red candles all the way down. Textbook shorting opportunity. Taking a look down here at the RSI is obviously trending lower, putting in lower lows, lower highs, all the way down below this yellow moving average. Not quite falling into oversold territory yet, but not far off either. So I think that it will fall a little bit further. The DXY is currently trading at about 102.47. I think that we will fall back down to 101.62, where we can expect that support level to kind of kick in, support price action a little bit, and possibly buoy the price. At some point, I do think that it's gonna break. I can't tell you exactly when. It might be this week, it might be next week, it might be 6 months in the future. But if we do break through this level, I think that you are gonna see a little bit more upside to stocks, so keep an eye out for that. Jumping over into the NASDAQ. NASDAQ has just continue to push higher. I did think that this gap from Friday, June 9th was potentially an exhaustion gap, and that was quickly proven wrong as price action opened Monday morning and just went pretty much straight up. You can see that we gave a little bit back towards the end of the day, but let's see, the high here was 15.11, the close was 14.986, so what is that, about a 30-point difference, 25-point difference? Very small points for the NASDAQ. You can see that we did put in some red days towards the end of that week. Might be coming down a little bit. We are still very extended from our 200-day moving average. Price is currently trading 24% above the 200-day moving average. That is very extended. I think that we have to give a little something back. Price action has been overbought since that same gap Friday, June 9th. So are we going to see a move back down to this 13,843 level? I like to think so. I think that's a good area. It was resistance. We broke through it. We didn't really see a retest though. So I think that it is entirely possible that we see a move back down to this level here. And then whether or not we continue falling or catch a strong bounce back up in a bullish direction, I think either one is kind of equally possible depending on some more macroeconomic events. Jumping over to the Russell 2000. You can see from my last week's analysis, I did have this 1923 level scoped out, and we tagged it almost perfectly. The high came up here to 1929, so called that one perfectly. Ran right into this resistance level and then kind of started seeing a little bit of weakness. So I'd like to see early on this week, Monday, Tuesday, how that works out. The other thing to note, we do have this I guess you'd call it kind of an ascending triangle, but we do have this trend line intact right now. So if we break that and continue to the downside, we do have the 20-day moving average coming up below us, as well as the top of this consolidation channel. I don't want to see the Russell fall back into this consolidation channel. Realistically, I would like to see the Russell break out of this. Zooming out to a weekly time frame, we have not been above this 1923 level since April 2022. Little false breakout here, little false breakout here, but we haven't really been above it since April 2022. So it's been over a year. I would like to see at some point the Russell break out, retest these local highs, maybe get a retest at the 1923 confirmation, and then I'd like to see us move back up towards all-time highs at around 2470 or so. That's what I'd really like to see from Russell. But like I said, the Russell does like to just kind of move sideways for long periods of time. We have this trend line holding currently. I'd like to see it continue to hold and just force price action up through this 1923 level, and then, you know, kind of I think you might see a lot of stop orders get filled there from shorts who were, you know, anticipating a price movement back down, get some buying pressure, retest local highs, retest 1923 level, and then off to all-time highs. Jumping over into the Dow Jones, pretty much called this one perfectly too. Dow Jones moved right up into that 34,345 level, got a really solid red candle forming right now. You can see big wick on the top, moving back down. Let's see, the low is 285 and it's currently at 299. So 14 points on the Dow Jones. That is pretty much an accounting error. Nothing to be concerned about at all, but I think you might see it come back down to the confluence of the 20-day moving average and the 50-day moving average. Taking a look down here though at the RSI is looking a little bit overheated, so you might need to cool off a little bit before we get that break through this 34,345 level and possibly up to 35,410 and maybe even beyond. Now, it is time for my trade of the week. I want to make it clear up front that this is not financial advice, and this is a high risk trade. We are going to be taking a look at Coinbase. The ticker symbol is COIN. It's coin. Coinbase, ticker symbol is coin. It makes sense. If you take a look at the stock here, this Monday, June 5th, you see this ugly red candle on Wednesday and a big gap in between. That was when the SEC announced that they were going to be suing Coinbase. Now, the SEC is run by a bunch of clowns, in my opinion, and I think Gary Gensler has no idea what he's doing. They are accusing Coinbase of selling and providing brokerage services for unregistered securities, and yet Coinbase is a publicly listed company. The amount of scrutiny and documentation that they had to provide to the SEC in order to get listed is pretty much the exact same things that they're going to have to, provide throughout this court case in order to prove that they are not selling unregistered securities. I think that this is a completely ham-fisted move from the SEC. I think that there's really no teeth behind this, and it's probably even worse than them going after Ripple Labs and XRP, which I have always thought was a complete clown move from Gary Gensler. I think there's really no substance to this. I think that the SEC has been grasping at straws, and they're possibly trying to reestablish some form of credibility. But like I said, this is a high-risk trade. They are embroiled in a lawsuit with the SEC, so that is not a minor detail. That's a very major detail. If that makes you uncomfortable, don't trade, don't play around with it. Please don't do anything stupid with your money. The most important thing is you being able to sleep at night knowing that your money is safe. The trade idea is fairly simple. Coinbase has been trapped in a consolidation channel for quite a while now, going back to May of 2022. Following this announcement by the SEC, we came down, kind of wicked the bottom of our channel and moved back up. Still trading below all our moving averages, but all I'm really looking for here is a break above our moving averages, which would be probably about $60. I would want to jump into this, and then there's a couple different ways you could play this. So if we jump in at about $60 here, we'll go about here. You could ride this up to the local high, which is going to be about 66. That'll give you 10%. If you look left a little bit further, you could ride this up to about 71, which would take you for about 20%. You could target this gap fill, which would take you for 29%, or you could even take it all the way back up to the top of the channel for about 35%. No matter which way you look at it, I think that you have pretty solid risk to reward here. Let's just go ahead and put in a position so we can really get a solid grasp on what that looks like. Here, yep, we said maybe 66 for the first one. Kind of keep this pretty tight below the stops here. Below the moving averages here. So if you took it up to 66, you have a 1.34. It's not great. It is still above 1, so it's not terrible. It's not great either. I would actually say it's a little poor for me. So I would target something a little bit more aggressive, maybe up to that 71, 72. That puts you at 2.5. That's a lot more solid. Taking you up to the gap fill, puts you at 3.61. All the way up to the top would take you for about 4.5. So somewhere between 1.3, 4.5 risk to reward ratios. Not terrible. This is a super easy trade, just waiting for price action to break above our moving averages and kind of move up to the top of the channel. This is a channel consolidation trade. Thank you guys so much for watching. I do appreciate each and every single one of you. If you miss my beautiful face on your screen, I know, I'm sorry. I've been having a lot of problems with my screen recording software, so I'm hoping this fixes the issue until I can find another one that I like, and then I will put my bright, beautiful face right back in that lower right-hand corner for you, because I know you all miss me. Please go down, smash that like button. Much love, much appreciation. Peace out, homies.